In the previous video, we finished with some common features found in developing countries. We will now continue with developing countries' borrowing and debt patterns by first introducing it. The main feature of many of the crises faced by developing countries is their borrowing and debt patterns. First, developing countries mainly borrow from outside of their own country to invest in infrastructure. Debt between developed and developing countries now stand at $5 trillion. How does this work economically? If a country borrows from another to finance investment, there will be a deficit on the current account. The current account is the difference between domestic savings and domestic investment. If domestic savings is insufficient to cover investment, and the current account will be in deficit. In Chapter 6, the intertemporal trade is covered. Again, as discussed before in the course, the motivation of borrowing is also important. If it is made for productive investment, it should pay for itself in the future. If not, then consumption borrowing might cause repayment problems. The problem of repayment and default is what causes many of developing countries' problems. Here are some definitions of crises that will be important going forward. A loan is in default when the borrower, without prior arrangement and agreement with the lender, fails to repay on schedule as stipulated in the loan contract. A debt crisis arises when the government is unable to repay its debt with other governments, or when there is an overabundance of debt in the private sector and firms cannot repay this debt. A balance of payment crisis arises when the central bank of a country does not have sufficient foreign reserves to pay for imports and exports. And a banking crisis is when banks become insolvent or runs on the bank take place. This was the case in 2009. Besides the crises that we will look at later in the session, there is a wider history of default by country. American states defaulted in the 19th century to European powers. Latin American countries defaulted several times during the 19th century. The new communist government in Russia in 1917, after the Russian Revolution, defaulted on the debts of previous rulers. And during the Great Depression, some developing countries defaulted on their debts. After apartheid and to re-enter the global economy, the negotiators declined to default on the apartheid government's debt, but rather took it on as a show of good faith. This worked for investment and appeared to be a good choice. What is a sudden stop and the problem with it? The problem, remember, the current account is the difference between domestic savings and investment. If the current account is 5% of GDP and foreign lenders cut off loans, then either savings must increase by 5% or investment must fall by 5%. Savings do not tend to change much over the long term, and this usually means that a sudden stop causes a dramatic decline in investment. But a change in savings will have the same effect. Remember, more savings means less consumption. This causes a dramatic decrease in output. Use your knowledge of macroeconomics to ensure you know how this mechanism works. A sudden stop further means that suddenly the current account must shift from a deficit to at least equilibrium, but more likely to a surplus. A crisis like this is often self-fulfilling prophecies, and default leads to balance of payment crises and bankruptcy. Other than borrowing and debt from other countries, there are some alternatives for financial flows between developing and developed countries. These most common forms is debt finance and equity finance. Debt finance takes the form of bank finance or portfolio investments in firms. Equity finance takes the form of foreign direct investment, bank finance, and official lending. The problem of developing countries borrowing is exacerbated by the original sin. This refers to the problem that developing countries are only able to borrow in currencies like the dollar. Suppose world demand falls. In wealthy countries without much external debt, wealth is transferred from foreigners to the country that experienced a depreciation in their currency. Remind yourself of how a decrease in demand leads to a depreciation. But if you are a poor country with dollar-denominated debt, a depreciation means more repayment and wealth is transferred to wealthy countries. This is the problem of the original sin. An alternative view by other economists are that developing countries' history of ill-advised economic problems are the problem rather than their borrowing. We now move to two recent crises experienced by developing countries. The first in the 1980s in the Latin American countries, and the second more recently in the 1990s. Between 1981 and 1983, the world economy experienced a recession. During this time, the dollar appreciated and developing countries started to experience problems repaying their debts. During this crisis, Latin American countries were the hardest hit, which is why we focus on them here. Some economists describe this period of crisis in Latin America as the lost decade. The crisis ended with low interest rates in the US, but more importantly was Latin American countries' stabilization of inflation, limiting the government's role in the economy and raising tax revenue. After the crisis, governments also lowered trade barriers, deregulated labor markets and product markets, and improved financial market efficiency. All the common features of developing countries that we have discussed before. Let us look at some specific experience of Latin American countries. First, Argentina went through radical institutional reform after military rule. One of these reforms was to make the currency convertible to the dollar, a way of fixing the exchange rate. While this helped, it continued to experience inflation in the early 1990s. This ultimately led Argentina to default on its debt in 2001. Brazil had to introduce a new currency in 1994 in order to deal with the crisis. The government also committed to reducing import barriers, privatization, and to fiscal retrenchments. However, it was only in 1999 that the real was devalued and allowed to float that Brazil's economy started to recover. In Chile, they imposed a crawling peg as an exchange rate regime to lower inflation. They further required that capital flows be non-interest bearing on 30% of the transactions. The Chilean economy started growing and it has had lower inflation since then. It has also seen a reduction in corruption. Mexico had changes in its exchange rate regime from being a fixed exchange rate to a crawling peg, and even more flexibility since then. This meant foreign reserves fell in 1994, and the rampant moral hazard in Mexican banks and financial markets meant the government took over and devalued the peso. Mexico had to ultimately accept emergency loans from the United States and the IMF, after which Mexican inflation dropped significantly and the peso depreciated. A more recent case of economic crisis in Latin America is Venezuela in 2019. This was caused by a collapse in oil prices, Venezuela's main source of foreign income. This led to collapses in basic supply and immigration increased from the country. There was also a collapse in infrastructure and it caused hyperinflation in the country. To contrast the experience of Latin America, we will move to East Asia in the next video.